Hey everyone, me Kevin here. I've been giving the Wells Fargo credit line cancellation issue a lot of thought and why it could be actually happening and what implications that might have for the broader market. So let's talk about this a little bit. First of all, in case you don't know, in case you haven't heard yet, Wells Fargo declared that all of a sudden anyone with a personal line of credit is getting their personal line of credit canceled. Now, here's something that's very important to know about lines of credit. The lines of credit are like credit cards, but they usually carry lower interest rates. The cool thing about lines of credit is you only pay interest on them, generally interest only, when you use the line of credit. So if you have a home equity line of credit, which I'm a big fan of, I can write a check from a line of credit if I need to or not. So for example, I have a $125,000 line of credit on my house. If I want to write a check from that for $125,000, I can do that and it's like cash. Then I pay interest on the balance that's outstanding. I repay that over time, however I want to repay it, and then I stop paying interest on that money. It's very, very convenient. I see lines of credit as a very good emergency fund. And they're also a relatively safe emergency fund. For example, home equity lines of credit, which those aren't getting canceled. Those usually carry lower interest rates and the collateral is real estate. Personal lines of credit, those carry slightly higher interest rates, but they give folks a line for emergency purposes, or if they want access to cheaper credit than credit cards could offer. Now, why is Wells Fargo ending these personal lines of credit potentially dangerous and risky? Well, in my opinion, first of all, there are a few issues here. The first issue is you're removing liquidity from people. That is, people have less access to cash. When people have less access to cash, you, first of all, reduce consumption, which is a big problem. So a side effect of having less liquidity is you reduce consumption. That hurts the economy, that hurts growth, that's bad. Now, it's just Wells Fargo, but then again, Wells Fargo is a big company, okay? It's part of the big four, Bank of America, Citi, Chase, right? Big company, so it's a big deal. So liquidity is obviously an issue. Consumption can go down, growth can go down with individuals who would otherwise be able to use their personal lines of credit. Now, what else is an issue? Well, the other issue of not having access to this liquidity is you potentially end up driving these individuals who had personal lines of credit into riskier forms of credit, such as credit cards or personal loans. Now, the reason personal loans are riskier than personal lines of credit is because, again, with a line of credit, you're only using the money when you've spent it. You're only paying interest on the money when you spent it. You go into Wells Fargo and you go, I want a personal loan for 100 grand. They give you 100 grand. You're paying interest on that whether you need the money or not. That's a problem. That's an issue in my opinion. I'd rather have a line of credit. Now, you do have credit cards as an option as a line of credit at Wells Fargo, which is something they said, we got personal loans and credit cards. But you got to be out of your mind to pay the interest rate on credit cards, which sometimes exceed 20%, 20 to 24%. It's absolutely nuts. It's highway robbery. You should never pay a dime of interest on some of these ridiculous credit cards. So that's very risky, in my opinion, and it's dangerous. And so what does that potentially do? Well, in my opinion, it potentially drives folks into using margin on maybe investments that they have, such as stocks. Now, unfortunately, margin is risky because if your underlying collateral falls beneath a certain point because the stock market corrects or whatever, well, all of a sudden you could get liquidated. And so you're forced into the situation where either you don't have an emergency fund or you use margin as an emergency fund or to fund your consumption, or you use more expensive credit cards. And all of those things are worse for the consumer. It's worse for Wells Fargo customers. Less access to liquidity is bad for the economy. It's bad for Wells Fargo customers. Now, Wells Fargo is probably looking at this as a profit driver because they're like, if people are using these lines of credit, they have all this access to credit, but maybe they're not using it all. Well, let's take away that opportunity from folks and force them into higher interest rate products. That's the only thing that makes sense to me because remember, businesses are, and this is why, look, I'm a big fan of free market capitalism and everything, but, sometimes business motives are misaligned with societal motives. And one of those could be the fact that if Wells Fargo is saying, people have all this access to credit, but they're not paying any interest on this because they're not using it. How about we force them into something where they have to pay us interest? I almost feel like there's a secret profit motive here that Wells Fargo is going for. And if that's not true, then Wells Fargo should come out and give us a real reason, because right now they're not giving us a real reason. And it's scary to me because it makes me wonder what's going to happen at other banks. Is this the first of many? Now, I don't want to, come across as like fear-mongering or whatever, but you always want to look at that. If one of the big four is doing it, why? I mean, either, look, the other banks can look at this and go, great, more customers for us. Wonderful. Go switch from JP Morgan or from Wells Fargo and go to JP Morgan, whatever. Go to the other banks. But the danger is that this sets some kind of precedent that we're going to get rid of personal lines of credit, because here's the thing. During the pandemic, home equity lines of credit have been much harder to come by. A lot of banks aren't even doing home equity lines of credit anymore. A lot of banks used to do rental property lines of credit. After the pandemic, they're not doing these anymore. So it's really interesting, because really what you're doing is you're eliminating liquidity opportunities for people, and you're pushing them into riskier forms of debt, credit card debt or margin. And here's the thing, margin rates, the May data that came out, highest levels we've ever seen before, over $830 billion. I thought maybe the margin debt, a few months ago I was saying, hopefully we start seeing margin debt go down and we start seeing a deceleration of people using debt. No, we haven't seen that. We're seeing more debt flowing into the stock market. So it makes me nervous, especially if folks' emergency levers are being taken away and they're being forced into higher credit or higher interest rate bearing accounts to have liquidity. And potentially other banks follow suit, robbing folks of consuming power. That slows down the economy, that slows down growth. And all of this is honestly quite ironic, because banks they're flush with cash. They got too much money, they got too much cash. So part of me wonders, the other possible reason is, if it's not a profit motive for banks, then it has to be a risk aversion reason for Wells Fargo to do this. In other words, are banks worried that markets are inflated? We're starting to see a slowdown in the economy. We're seeing real disposable income go down. We're seeing consumption go down. We're seeing credit card transactions go down. We're seeing mobility data going down just month over month over the last few months here, which makes sense. You get a big explosion at the reopening and people kind of go back to settling into a normal average, like a pre-pandemic average. But look, if the stock market is valuing companies at all of a sudden these new massive growth metrics, and then companies like Wells Fargo are going, oh man, we have too much potential for people to take debt out there. It's too risky, because if we have a bubble or something that pops, which, look, I'll give you my odds in a moment. Well, then maybe Wells Fargo is trying to mitigate their risk that way by making sure people don't have access to all this money during a potential crash, which sucks because you want cash during a crash so you can buy the dip, right? But anyway, maybe that's what Wells Fargo is doing. Maybe their administrators or their executives are going, look, they're not profitable now because people aren't using them maybe. I mean, that's one option. Or the other option is, hey, if we're going into a market correction, we don't want folks being able to take out a bunch of debt in a correction, which does happen. Like in the recession in 2008, we saw credit lines get frozen. It's one of the first things that happened. Credit lines got frozen. When the pandemic came in February of last year, I warned everybody. I said, folks, draw down your lines of credit. And what that means is you literally go to your credit lines and you take all the money out and you go park it somewhere else, maybe even at a different bank. Usually you don't have to do that, but you could park it at a different bank. And why are you doing that? You're doing it so you have access to that money before they freeze your credit line. So I don't know. It's weird. Now, regarding odds, I still believe I've revised this up a little bit. Okay, I was saying like 5 to 15% chance of an S&P correction of somewhere between 15 to 20%. I think that's maybe closer to 15 to 20% now. And this is something we've been talking about over the last few days. Just some indications that we're seeing. We've talked about in other videos. So anyway, I am a little bit worried about this Wells Fargo thing being a little bit of it's a red flag, put it that way. It's a red flag. I don't know. Let me know what you think. Thanks so much for watching. Make sure to subscribe as always. Take advantage of that 40% off coupon code down below. That does expire July 22nd. And folks, the price will be going up on July 23rd, the morning of July 23rd. So get in. And folks, we'll see you in the next one. Bye.